You're the owner of a small business, which means you're also the tech guy, and HR, and personal assistant, and head honcho, and intern. You could use another pair of hands, like the experts you'll find at Verizon Small Business Days, April 21st through 27th. Get a free tech check, special deals, and more. Call 1-800-483-4428 or visit verizon.com/smallbusiness to book your appointment. Verizon Business.
Reality radio for a really great future. We're talking real money.
Well, welcome to the Labor Day weekend. It is officially the Labor Day weekend. Labor Day, the day on which we're not supposed to labor, but a bunch of people do anyway.
We're here live, and we're doing it for you because we want you to help. We want to help you.
We want you to help us, please. Today,
exactly.
Today, we're asking. We're gonna turn the tables, and Tom needs your help. He does.
I knew this was going to happen today.
He desperately needs your help. He's been way too excited leading up to today's program, and you know, I don't know that it's for good reason, but we'll find out.
It's not, and I was trying to get myself jacked up after literally watching one of the worst soccer games. And I've seen a lot of bad ones over the years. This was like a real snoozer.
One, it's soccer, which kind of dozes anyway. Two, it was Iceland.
Yeah, it was.
I mean, what?
It played at that pace, too, by the way, at pace.
1/10 of the Icelandic population is on the soccer team.
I know, but there was one guy who made such a bad mistake. I said, he's going to be back fishing by about Monday. Yeah. So they're going to go, hey, how'd the weekend go? Not too well.
Hey, they put me back on volcano cleaning.
Exactly. Good luck.
I got to scrub out the caldera.
So we are here live and in person, ready to help you with your money and finances and all that stuff. Because frankly,
or so we say.
The reality is we don't have anything better to do with our time. So there's that.
Well, there's COVID. There's that.
Oh, we're going to solve that this weekend?
Yeah, no, I don't think so. No, I'm not even going to go there because
I'm not going to go for the vaccine test or anything.
It's become way too political, so I'm not even going to talk about it.
I think that's a good idea. Leave that one.
Find my mask.
Other people.
Probably the best thing I could do right now. Hey, hi, everyone. I'm Don. That's Tom. He didn't introduce us. I will. We're the hosts of Talking Real Money, the every week show that helps everybody everywhere, particularly those in the Seattle area, make better financial decisions, avoid being ripped off, plan for the future as opposed to emotionally reacting. We're going to talk some about all these things and do the stuff that science has found to be effective. That's what we're all about. And we do appreciate it. You help us out a lot when you call. You do. It means a lot to us. So here's the phone number. Chokes me up a little bit to share this with you. 855-935-TALK, 855-935-8255. Give us a call.
And good news is the calls always move to the front because the stuff we got, we can sit around and talk about for days, years.
Yeah, and we do.
Millenniums. Yeah, we will.
Millennials,
so call.
Millennials and millenniums.
I told you this was going to be a slow start.
We talk about millennials for millennium.
Exactly. So,
or billions of years. Did you know? I just read a thing. Very cool. It has nothing to do with money. But a bunch of scientists have been slaving for 20 years, these astronomers, and they created a 3-dimensional map of the visible universe. I think that's so cool.
Where do you find this stuff?
I don't know. It's factoids I find. And it's so cool because, you know, there are like billions of galaxies. Not just billions
I have nothing
but
the highest respect for people that can work on a single project for 20 years.
I know. Isn't that incredible?
I don't do well after about 20 minutes. So, I mean, I just have nothing but the greatest respect for them.
I need new stimulation. I need another gig. I agree. Give me something new to do.
Good for them. I think that's remarkable.
On the radio.
Can you put that up on the website so we can see that?
Not a chance. It's 3-dimensional. Okay. Your computer can't handle it. It's too big a file.
Okay. I can't handle the truth. Okay.
855-935-TALK. Give us a call. And did you notice something happened this week? Like
somebody
Thursday?
said something about stock prices took a big dive. You know, here's the way I always know. That's interesting. Because we read the industry stuff. We look at the industry websites. But when it gets to the front of CNN or another one of those news sources and it's on the front, then I know that people are going to ask me, because they were screaming out the headlines on Thursday. Stock market tanks, technology creamed, et cetera. And by the way, technology did go down by about 5%, the NASDAQ on Thursday. That's a pretty dramatic turn. And then yesterday, it went straight down. And then if you noticed, the last hour, straight back up. So it ended up down yesterday, but nowhere near where it had been earlier in the session. So, yeah, that was a little bit worrisome, I think, to many people.
Well, I got to tell you, I hate to say I told you so, but I told you so, that the NASDAQ was getting into this heady territory, but I don't predict things, Did you just whistle?
I did. I was trying to make the heady sound like,
oh, you were trying to do sound effects.
I know. I can do some bad ones if you want.
No, good. We're good. But no, here's, folks, we love you to pieces. We do. Or we wouldn't be doing this every Saturday forever. But you're kind of confused about this whole investing game. You think investing is like picking the hot stocks. And it's not. It isn't. You got to understand, this is what happens. We get these big declines, but it's not the market. That's one of the things we're going to talk about. You, though, preempt all of that. Sent to the front of the line, as Tom said, by calling 855-935-8255.
Tom and Don are talking real money.
At Vestory, we want to help everyone reach the best financial future. That's why we offer free meetings with our advisors with no obligation and no sales pitch. Set up yours today at Vestory.com or call 800-386-3004.
For your real life and real future, Tom and Don are talking real money.
Happy Labor Day and happy COVID spike next week. 855-935-TALK is our phone number. You know it's going to happen.
Said you weren't going to do that.
It happened over Memorial Day because we want so badly to be normal. We do. It's so funny. I was in the paper today looking at the map of COVID, where the worst COVID cases are. And one of the biggest hotspots in the country is right around Rapid City, South Dakota.
Ooh,
curiously enough. Wonder about that Sturgis thing.
Let's not bring that up.
Hey, everybody. Please. Welcome to Talking Real Money. I'm Don. That's Tom. 855-935-TALK is our number. We talk about money, mostly. And I love these headlines in the popular press, like Barron's, which is owned by the Wall Street Journal.
Indeed.
The stock market's August gains become September pain. Didn't we just have 2 days of down prices? And that's September pain?
Apparently it's going to continue into next Tuesday and beyond.
That sounds predictive to me. And, we need to we talked about this before the break. We need to make this really clear. What went down was the NASDAQ, which is mainly tech stocks. They used to
be a lot of big tech. Yep.
What went down was the S&P 500. What went down was the Dow. But not everything goes down.
Yeah, I think that's an important thing to consider. It's also important to look at perspective. For the last 6 months, the market has been up quite a bit. Number three, kind of around that aspect, is we talk about this all the time. You need to own a lot of different types of stocks, different countries, different industries, because not everything goes down and up and down all around together. And so
it's like a little song you just wrote.
How about that? Yeah. I thought it was going to be a bad show. So, because we know companies that were once the great disappear. And the ones you really believe were going to be terrific don't work out. Things are cyclical. That's why you kind of own all of them. And Jason Zweig piece today in the Journal does a nice job of talking about how Apple is now the largest firm in terms of valuation. But if you go back 100 years, there were a lot of other companies that were AT&T, General Electric, not doing too well today. General Motors, not doing too well today.
Well, what about all those that don't exist today?
Right.
American Ice. That was big back in the 30s. Doesn't exist anymore.
There have been 25,000 companies that have gone public basically in the last 100 years. in the United States. And there's what today, like 5,000, 6,000. So yeah, a lot of them have gone away. And so things are cyclical. Don't get caught up in, the recent activity. This is going to mean what the future is going to look like. That's bad. And don't concentrate your portfolio, because we do know concentrated portfolios can lead to huge losses. All you got to do is see 2000, 2008, places like that where you just got hammered.
And just to put your mind at ease, when you hear Tom say 25,000 companies were formed in the last 100 years, and there are about 5,000 in the U.S. that exist to this day, bear in mind that even with those 20,000 companies that went away, the market, the entire U.S. stock market, returned on average right about 10% or so a year over 100 years.
Exactly. So just spreading it out, keeping your costs low, not paying attention to what's going on day to day has been a pretty doggone good strategy for a long time. And my guess is it'll still be a good strategy for a long time into the future.
855-935-TALK. Give us a call like Gail did. Hi, Gail. Welcome to the show.
Hi, thank you. I was listening to your show last week, and you gave a little history about Dow Jones and
yes, ma'am,
why we shouldn't pay attention to the Dow Jones numbers right now. Could you give a little more history on how would that come about, and then in relation to the New York Stock Exchange, could you give us a little history orientation?
Let me just tell you about the Dow. Back in the 1800s, Charles Dow wanted to have some sort of a number that he could use, that could be used to give people an idea of the changing value of the stock market, of the New York Stock Exchange. They didn't have computers capable of regularly calculating the entire market capitalization of the market and then figuring out some way to index that and come up with a value. So he literally came up with the simplest thing he could figure out that you could do on a day-to-day basis, on a minute-to-minute basis even, and that was to take the value of all the stocks, and at that time I think it was 12?
I can't remember. It was a small number.
It was a small number. I think it was 12, maybe 15. And he added up all those companies and then divided them by the number of companies, and that gave you the average price of all those companies. It's a terrible, terrible indicator.
It's an important thing to consider, yes, because if you look, for example, at the Standard & Poor's 500, they arrive at the index price by looking at the value of each company, the number of shares outstanding times the share price. Then they put that index into the index and divide. What Don's correctly pointing out is with the Dow Jones Industrial Average, which in and of itself would be a crummy index because it's only 30 stocks. Mm-hmm. So that makes it lousy right there. It's only 30 U.S. stocks. And then it's this horrible formula of taking whatever price, adding that in. I mean, that's just, it's completely irrelevant. It truly is.
Well, plus it's even more irrelevant in that it's not the industry. It's not the market. It doesn't reflect the value of the total stock market. And by the way, it was 12 stocks. It was 12 stocks. Oh, there's a much better alternative. It's called the ACWI, which is the All-Country World Index.
Which you could type that in at
it's
wherever,
hard.
Right?
ACWI is very protective.
Because they used to have the global Dow that you could look at too, but I don't know if that's available
wasn't
anymore.
everything. That wasn't everything. But there is an ETF that is the ACWI, and that'll give you some idea of where the global market
you could just go look at the changing price of the VT wax to get a feel for kind of what's going on globally. And they don't report that. It's again, these are things that just get caught up with the momentum. The Dow Jones Industrial Average has been there a long time. People have listened to that average for many, many years. And it's kind of lazy. The media just says, we'll go with the Dow Jones because we know it and people will buy into it. But
does that answer your question?
Yes. So it's all American stocks, the 30 on the Dow Jones.
Yes. And it's kind of
large,
kind of arbitrarily selected too by committee.
That's why it was in the news, because recently I think they threw 3 out and put 3 new ones in, if I remember right.
They threw Exxon out of all companies.
Which was the biggest company for many, many years.
Oh, up until Apple usurped it. It was the biggest. Yeah. And I don't like it. I wish people would stop quoting it. I'd rather them use the S&P 500.
This has nothing to do with your relationship with Charlie Dow, correct?
No, we're still good friends.
Tom and Don are talking real money.
If you're sick of your self-interested financial advisor and are looking for a 100% fiduciary low-fee investment advisor, call my firm Vestory at 800-386-3004 or visit us at vestory.com.
Your guides to a really great financial future. Tom and Don are talking real money.
Welcome back. 855-935-TALK is our phone number, 855-935-8255. And the Dow was started in 1896, originally 12 companies. And this is kind of fun because let's go through the 12 companies. There's only one that still goes by its original name in 1896. Name
I don't even
that
know if I know.
company.
I guess 96. I'd have to go with General Electric. But
You
I don't think
nailed it.
Right.
That is absolutely correct.
So I was
it is
I can't
the
think of
only
else,
one. That's still as it was.
By the way, that is now the 118th largest company in the United States. General Electric.
Now, American Cotton Oil was part of that.
Oh yeah. Well, I used to trade that.
Well, they became.
I'm kidding.
Best Foods, which is now owned by Unilever. American Sugar. It's now
poor branding.
Owned by Domino Foods. Domino Sugar.
That was a sweet trade, but it didn't last long, as I remember. It kind of went up and then down.
American Tobacco was split up, and then it ended up being called American Brands, and now it's Fortune Brands. Chicago Gas was People's Gas, and now it's part of Integris Energy.
Wait a minute. There's a company called People's Gas.
There was.
I got to think that through a little bit.
Gas.
Okay.
Distilling and cattle feeding. Now, who would have thought distilling and cattle feeding went together?
That is what a great brand there.
But think about it. It makes perfect sense because when you distill, you cook grain, and then you're left with, and then you feed the dry stuff to the animals. So
that's
now
exactly right.
It is. It became a lot of things. It was National Distillers. Then it was.
I'll bet it did. I know a few of the things it became.
Then it became part of American
after they fed it to the cattle. Sorry.
There's Laclede Gas, which I guess is still around somewhere, but I'd never heard of them. National Lead. There's another business.
I heard they were sinking very fast.
Yeah. They moved into paints. Dutch Boy Paints.
Okay.
That's them.
Yeah, makes sense. Yeah.
North American. It became Wisconsin Energy.
You know, I think the takeaway here is...
I got 3 more.
Okay, please finish. I don't want to interrupt your...
I got 3 more.
Diatribe.
How about Tennessee Coal Iron? How about Tennessee Coal, Iron, and Railroad?
Coal, Iron, and Railroad. Yeah, okay.
It was acquired by U.S. Steel. It was acquired by U.S. Steel.
Decent company there, too.
U.S. Leather.
Mm-hmm.
Yeah, they're not. They're gone. No trace of U.S. Leather anywhere. No. United States Rubber. B.F. Goodrich. And then it was bought by Michelin. So you see how things change.
Yeah, no, I mean, I think, again, because you suggested I watch this documentary, which I did last night, which I really enjoyed, the one on the theme park. There's a theme park in New Jersey where it's a horrible story because people end up dying. You don't go to the theme park expecting to die, but somebody at the end of it says it was a time and a place, and it made sense in that time and place, but it doesn't today. I think that's true of a lot of businesses, right? Things come along, they work for a while, they get snapped up by somebody, and even those companies sometimes just decide, I don't want to keep that anymore. It's not working, or they shut it down. And again, that's why you own a lot of companies, you own a lot of countries, you spread it around because you don't know where that next Apple, Microsoft, Amazon, et cetera, could be coming from. And I wouldn't bet on technology right now either, by the way.
But Tom, I'm sure that Amazon rules the world right now. They're the biggest retailer in the world, right?
They're not the biggest retailer in the world. And number two, they make up like 1.2% of global retailing. They don't. Just the fact that, they can have it here in the next 10 minutes if I order a book, that doesn't mean anything in many ways.
Well, yeah, and it's like Tennessee Coal, Iron, and Railroad. I mean, come on, it's a tiny part of...
maybe they're bringing the book. I don't know.
It's a tiny part of U.S. Steel, which is a tiny shell of its former self.
Again, what it shows to me is you really do need diversification.
Because with diversification, you'll own what is hot, you'll own what is not, but you will be participating in the one thing that we can relatively confidently state has a good chance of growing in the future, and that is the global economy. Can't guarantee it, but I'm telling you, if the global economy fails, you're not going to care what you're invested in anyway. 855-935-TALK. Give us a call. Let's talk about your money, your questions. Any of them go, as long as they're about your dough.
Tom and Don are talking real money.
Did you know I wrote a book? Yeah, about 10 years ago, I wrote a book about investing. Financial Physics, with an F, How Money and Investing Really Work. It's a short read. It's a really easy read because, well, as you know, investing is way too easy to be this complicated. And it's been on sale for a long time at Amazon. I updated it in 2018 to a new version. But if you don't want to buy it, you can go buy it at Amazon. It's $10. But if you don't want to buy it, if you want it free, well, you can get it free two ways. One, you can get a PDF copy by going to talkingrealmoney.com/free. talkingrealmoney.com/free. If you don't put in the /free, you can't find it. The other way is if you have an iDevice, like an iPhone or an iPad or a Mac, you can go get an interactive version of the book, a special edition that I made that's actually interactive, that's got videos and motion and things going on, and that's also free. Just look for Financial Physics, FYSICS, in the Apple Bookstore or Apple Books or whatever they call it now. Or go to talkingrealmoney.com/free, talkingrealmoney.com/free. And I guarantee you'll enjoy the PDF or the iBook or your money back. Check it out, talkingrealmoney.com/free.
Reality radio for a really great future. We're talking real money.
Welcome to the show. I'm Don. That's Tom. This is Talking Real Money. We talk about, money. We try to do it a little less stuffily than some of the other shows. I was listening to some of the other podcasts out there, and some of these guys are just pretentious. Well, the stock market.
Well, you mean somebody in the financial industry is pretentious and acts like they know a lot about things that they may or may not know about?
I was so shocked.
Yeah. Okay. They've also written a lot of books. They're online. A lot of other nonsense you can follow if you.
Yeah, as a matter of fact, I'll get to that later. We got people on the phone. I could talk about that anytime. Let's go talk with Brenda on Talking Real Money. Hi, Brenda.
Hi. Good morning or afternoon.
Afternoon.
So my question is, or just maybe some comments from you guys. I work for a big company called Salesforce that was just put into the Dow 30, I believe.
Yes, ma'am. You were one of the companies.
Yeah,
well
and
done.
I don't know a lot. Like, is that significant? How is that tied to like the S&P 500 or not? Or like, why do people?
Well, it's been significant for their stock price.
30?
Yeah, I mean, yeah, absolutely, because it signals that you're one of the major players, I'd say, in technology. Salesforce is an outstanding company. We actually have an employee who has a spouse that works for Salesforce. Not that we didn't know about it before, but yes, I think it's significant in terms of that. It wouldn't be a reason, by the way, to go buy the stock if I worked there. I would not. I've never been a fan of creative ways companies try to get you to buy the stock. There's a lot of them. They put them in your 401k. They do other stuff outside of that. They really try to encourage their employees to do that. I do not. For the following reason, by the way, you already work for that company. You're banking on them to pay the day-to-day bills. When you buy their stock, then you're banking on them to provide you for your retirement. I do not like putting all my eggs in that kind of basket. So
yes, I don't do ESPP, but I do have, RSUs, so I hang on to those.
And again, I would have a strategy for those Yep. I would have a strategy to clean that up over time as well once those are vested.
And it's been good for you just going into the Dow, as you can see from the fact that it jumped 50+% in just a few days. Yeah. But that is all this little psychology game. That's really all it means. It didn't mean Salesforce suddenly became more valuable. Remember, back in March, at the worst of the decline, Salesforce's stock was $125.
And what is it trading at now?
$254.
Wow. Yeah.
So it's more than doubled in less than a year. And that tells you that there's a lot of psychology at play here. Not a lot. As a matter of fact, if I had any stock and I could get out of it, I would probably just start taking some profits. At least take my initial investment off the table or something, because things do get a little heady and frothy when they get into the S&P or they get into the Dow or one of these indexes. But otherwise, it really didn't mean much. And Brenda, thanks so much for the call. We really appreciate
Congratulations.
it. 855-935-TALK's our number, and Cynthia's next. Welcome to Talking Real Money, Cynthia.
Hi. I tuned in late. Can you tell me what you see the future of Facebook is? And what the best index fund to get is?
I see the future of Facebook as my wife continuing to look at it every day.
Your wife should be the majority owner of Facebook. We took the time spent.
Let me tell you, my personal opinion is that one of these days, just like everything else, like we've been talking about today, the Facebook technology will be usurped by something we can't even imagine. I got to tell you, in 1990, we couldn't imagine Google. Couldn't have possibly imagined something like
everyone doing everything on their phone.
Yeah, you couldn't have imagined those things. And
30 years later.
And technology, the problem with being a technology company, particularly a technology software company, is that it is easy for new, brilliant ideas, just like a college kid named Zuckerberg, to create something for college campuses that became all the rage around the world. It's almost as easy for some other kid to take him down several pegs. So I would not own Facebook, not own it. I would not own any individual stocks, though. What?
Do you think it'll go up?
Oh, see, we don't predict that kind of stuff. It'll go up, it'll go down, it'll probably for a while go up more, goes down, but someday it'll go down and you'll never be able to catch it because nobody can tell you when these things eventually fall apart. That's why the best index you can own is the Vanguard Total World Stock Index, the entire planet, so you own Facebook and everything else.
Tom and Don are talking real money.
At Vestory, we want to help everyone reach the best financial future. That's why we offer free meetings with our advisors with no obligation and no sales pitch. Set up yours today at Vestory.com or call 800-386-3004.
For your real life and real future, Tom and Don are talking real money.
Once again, our phone number is 855-935-TALK to talk about real money with us. I'm Don. That's Tom. And, Cynthia asked about Facebook. And I told her what I thought, and then she asked if it was going to go up. This is what makes this, it's impossible to know these things. Let's flash back to 1990s, the 1990s.
30 years ago.
There was this hot stock in the 90s. Everybody was buying it and making a fortune, by the way. I knew a guy who was a bellman at Disney who put...
That's always a bad sign. Isn't that what Joe Kennedy said about the shoe shine guys?
Yeah. He put 10,000 in, and it turned into like $250,000.
Wow.
So it was the hot thing. And it was so hot at one point, the giant behemoth company, Time Warner, merged, didn't just buy them. As a matter of fact, it was not even a merger of equals. AOL ended up owning more of Time Warner than Time Warner did. AOL's position in Time Warner was worth $200 billion when they merged.
And for those of you who don't remember what AOL, that's America Online. That was how people got to the World Wide Web.
Yeah. And that
30 years ago.
That was in 2000.
And what can you remember about AOL today? The only thing I remember is the sound that it used to make when
you've got
connected.
Mail.
And there's that.
You've got mail.
Me. That and the sound that it made that. Yeah, exactly. It's that sound.
Anyway.
Yeah.
I didn't even, I had totally, I forgot so much about AOL that I didn't realize that in 2015, now remember, they were worth $200 billion in the early 2000s.
Yep.
By 2015, Time Warner sold off the AOL division to Verizon for $4.5 billion.
Wait, whoa. Give me the numbers again. 200 billion to 4.5 in like 20 years, basically.
15. Yeah.
And let me see a show of hands. How many of you are using AOL to get online today?
How many of you
Don't see very many
How many
hands.
of you still have an AOL email
My
address?
mother, God bless her, used it to her last days, but that was 10 years ago. So there's just not that many anyway. But that tells you everything you really need to know, because that was the company.
Yep.
That was the merger. I can remember what a big deal that all was, and then today nobody cares.
Yep. In fact, even Time Warner dropped the name from the company shortly thereafter. It was like, they're not doing anything for us anymore. Let's just drop the name. Yep. Hey, Jason, welcome to Talking Real Money.
Hi, Jason.
Hi, Don and Tom. Thanks for taking the call.
Our pleasure.
So, yeah, I have a question about. I've been listening to you all for several months. I appreciate the work you do. I was introduced to you all from the Paul Merriman podcast when you all went and spoke to him.
Oh, that guy.
Paul. How do you spell that?
I remember him vaguely. Is he still around?
I love Paul. Do you know how old he's going to be next month, by the way? I'm just going to say it publicly.
Oh, you aren't.
I am. Yeah, I am.
His birthday's
he was born
next
the
month?
same year as Jim Morrison. I'll just say it that way. You can
and
look
Jim Morrison's dead.
Since 1970.
Oh, okay.
Go ahead, Jason. Yes, Paul remains a friend. So
okay, great. Well, I know he's a big proponent, been following him for a while, big proponent of adding some small cap value index funds as a small portion of a well-diversified portfolio to try to, capture that greater return that it's gotten over the past 90 years. So we started doing that in our taxable account. We have a well-diversified account. We started doing that, but then I've learned more recently that it's a more controversial strategy than I thought. And so Paul was on a podcast with Rick Ferry, the White Coat Investor, interviewed both of them. Rick Ferry is the president of the John Bogle Center for Financial Literacy. And
we know Rick, too. Yep.
Okay, yep. So they a little bit kind of went at it on each other over whether that's a good strategy or not and whether that's necessary.
So what was Rick saying?
Rick's point was actually very similar to you all. He was just like, you don't need that. Buy the total stock market, buy the Vanguard Total Stock Market Index, diversify internationally, and leave it alone. And so you don't need to worry about the growth versus value. Most
actually,
okay, we're going to stop you.
Yeah,
there.
I'm going to cut in for a minute because I'm glad you said that, and that tells me a lot because I have not listened. I read about the Rick Ferry.
Yeah, I did see that. Yeah,
I haven't listened to it yet. I need to listen apparently now. But here's the thing. Paul is historically correct, and we agree with him, okay? But we disagree in that we are not comfortable telling everybody on the radio to go out and buy a portfolio that is overweighted to small, overweighted to value, because it adds a layer of complexity that most smaller investors won't do well with and generally don't need, because the fractional differences in returns when you're dealing with smaller amounts of money don't make much difference.
But that said, when we manage money, we do tilt the portfolios to small. We tilt them to value. That has added return. This year, it's been miserable, by the way. The S&P 500 is up over 7. Small is still down like 11. I thought you were going to say, hey, we did it for a while and it didn't work. There are periods of time it doesn't work. And then that premium pays, that what they call the small cap value premium, can pay for a very short period of time. You need to be exposed to it for the long haul. Again, we're going to disagree with Rick because I think history has, if it depends on what you're going to base it on. I think historically, if you looked at the numbers, you would tilt the portfolios to smaller and more value-oriented companies.
In fact, I recently read a piece by guy at Dimensional. I'm blanking on his name now. The former CEO, David Booth, where David Booth said there was a period of 15 years almost when growth outperformed value, for example.
And then what happened?
And then it took a month
for value to outperform growth over that entire 15-year period. So if you got out of value because you thought, well, growth is beating it, and you were out and you didn't get in for that 1 month when value exceeded growth by so much that it turned the entire 15-year period around, you made a big mistake. Does that make sense, Jason?
Well, it does, absolutely. I appreciate it, and thanks for answering the question.
My pleasure, our pleasure.
Yeah, this is always, I mean, and by the way, at the end of the day, there is a little bit of a decision you all have to make as an investor, and that is, who are you going to believe? I believe the academic work that does show that. So but you're right.
But you have to be patient. That's part of the problem, is we are impatient as a species. 855-935-TALK. Lori, it's your turn. Welcome to the show.
Hello. Question. What's the major difference between mutual funds and ETFs? And if there's any advantage over ETFs versus mutual funds, like when you're doing the Vanguard VTWAX or VBLTX, those are the mutual funds.
Wow, you know your symbols.
Woo, got your tickers down there. Way to go, Lori.
Okay, Lori, let me real quickly, because of the time factor, tell you what the big difference is. ETFs are just younger. ETFs trade all the time, minute by minute, second by second on the market, and there can be spreads between the bid and the ask of ETFs that doesn't exist in a no-load mutual fund. However, that being said, plus there's the other factor that there was the flash crash several years ago where a lot of ETFs ran into trouble. Their values plunged when they were supposed to stay stable because market makers walked away. They backed away. That being said, broadly diversified indexed ETFs should not be any different, and should not be. We do not, I can't guarantee it.
They're cheaper too, by the way. They're cheaper.
Yeah, they're cheaper to run, but they should not be any different than an indexed mutual fund. They should be the same. So if you were going to buy VT as an ETF, the Vanguard Total World ETF, or VTWAX, the mutual fund, it's going to be about the same. The VT is going to be fractionally less expensive, but I wouldn't mind having either one. Thanks for the call.
Tom and Don are talking real money.
If you're sick of your self-interested financial advisor and are looking for a 100% fiduciary low-fee investment advisor, call my firm Vestory at 800-386-3004 or visit us at vestory.com.
Your guides to a really great financial future. Tom and Don are talking real money.
You know, thanks to the virus, we discovered the wonder of online classes. And I got to tell you, they've turned out to be far more wonderful than we imagined. And we've done a bunch of them. And we did one a few weeks ago, or a month or so ago, the New Science of Retirement Investing, which was so popular, but the recording was messed up. Plus, it was popular. So, if you missed that, or if you just want to see it again, we're doing it again on September 16th at 8 a.m. Pacific, 11 a.m. Eastern, and you can sign up for it. It's free. There's no obligation or anything. It's really easy. Just go to talkingrealmoney.com, click the register button, or go to the events button and then click register. That's talkingrealmoney.com.
We hope you realize that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately, consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Vestory, a fee-only registered investment advisor. Thanks for listening, and please visit talkingrealmoney.com for more information and disclosures. That should keep the lawyers happy.